Thank you for tuning in and welcome back, team. In today's episode of Real Estate Investing, we'll continue with our real estate investing guide with how to find investment properties. After you watch this video, you'll learn 4 key things, and the 4 things you'll be able to do after this episode are how to profit when you buy your new investment property, know your home shopping criteria, and where to find real estate investments, and lastly, what the buying process actually looks like. My name is Andrew Finney, your real estate geek. If you need help finding a top agent where you live, or if you simply want to drop me a line to say hello, my contact info is below. If you haven't already done so, please go ahead and subscribe to this channel now and like this video. Thank you. Okay, team, so let's take a look at this. It's really exciting stuff. So we're already past halfway through with our real estate investment guide. And in this episode, we're going to talk about how to find investment properties. In the last episode, we talked about creating a business plan. If you missed the episode, you might want to go back and check it out. It'll make a lot more sense tying it in now, how to find investment criteria. Okay, so let's go ahead and lead in with the first thing that you're going to want to know how to do. And that's how to profit when you buy your investment property. Sounds like a no-brainer, right? You're going to buy investment property for what? Money, right? Return on investment. Making it happen and helping you guys get out where you need to, where you want to be and achieving your goals. At the same time, you got to buy smart. You got to know what you're looking for. You got to know what makes sense and what doesn't make sense. Perhaps one of the easiest ways to illustrate this is to give you a little bit of an analogy here. So let's say that you had a property that was located at 123 Main Street. I know, very original, right? 123 Main Street. And let's say that 123 Main Street is currently on the market for $145,000. And the recent comparables show that the similar homes around it sell generally around $140,000 up to $170,000. Well, 123 Main Street needs a bit of work, and 123 Main Street is probably going to take about $25,000 of investment money to get it up to market standard to be able to make a profit and just put it into nice condition overall. So if you pay $145,000 for 123 Main Street and you dump $25K into that property, you'll be at the 170, which is at the top of what homes are selling for around this property and where it's located, right? And that doesn't even include all the closing costs, the holding costs, selling costs, unforeseen overages that you might have in the renovation stages of it, or other fees that you might have to pay. So you'll be underwater, you'll owe more than it's worth, and no matter how much work you do that property, you're not going to be able to make a profit on it if you're flipping that property out, right? So now let's say if the homes around it were selling for like $225,000, buying that property for $170,000 just made a lot of sense. So it's something to think about with a little illustration. The same principle will apply to other types of investment properties, like rentals, for example. So if your monthly expenses, including your taxes and your insurance on 123 Main Street, were $1,200 a month, and the average rent received every month was $1,100, pretty quick, you can see that you're at $100 deficit every single month. Now let's say that the average property rented out for $2K a month, and your total expenses were $1,100. Well, then you made a very healthy profit, right? So it's something to think about. It's something to consider as we progress, because it's important to know your investment strategy. It goes back to the other videos that we've talked about with niches and strategies, and then the last episode when we're talking about creating a business plan. Knowing how you're going to get into real estate investing is everything. Are you going to be a flipper? Are you going to be an investor? Are you going to be looking for buy and hold and rental properties, essentially, right? Knowing what you're doing is extremely important. So now the second part of the main topic of this episode, we're going to talk about investment property shopping criteria. It's extremely important to know what this looks like to you. In the last episode, I had asked you to actually illustrate and give yourself examples of what the ideal deal looks like to you. Give yourself a best case, a worst case, and the most probable case deal. Right? And now I'm going to ask you to illustrate what a property looks like to you. What's most important to you about the actual property that you're looking at? Having this game plan and identified up front will really help you. It's just like if you're going to get ready to make a new dish or something and you're looking at a new recipe. If you miss one single ingredient in real estate investing, it's not going to turn out quite right. It could be good, but it could be better. If you miss a few ingredients, well, I'm sure that you and I both have made that mistake trying out a recipe, haven't we? Thinking that, oh, okay, we got it. We're going to just add this as opposed to that, and then it comes out tasting like, bad. Right? So we wouldn't want to do that. Same thing is true with real estate investing. So make sure that you have your selection criteria down pat. Things when you want to consider when you're creating your property shopping criteria and your selection criteria are actually the town, the neighborhood, the property size in terms of square feet, the lot size, the property condition itself, how many units, if you're buying like a multiplex or an apartment structure or something, how many units are in there? What is the cap rate involved with a property? What's the cash flow look like? And what is the appreciation potential in that location of that area for that property? Now, there is a website that I really like, and I've talked about it before. I'll talk about it again. And in this episode, I'd like to introduce it to you if it's your first time you've ever heard about it. It's called Roofstock, roofstock.com. I'll go ahead and pop up their information right now. One of the things that I like about this for us beginning investors and for anyone that's looking to increase their investment portfolio is simple. It gives us the option to be able to purchase property around the country through a very convenient method on roofstock.com. It'll show us the cap rates. It'll show us whether it's rented out. They actually have professional property management available if you want to go ahead and hire them. One of the reasons this is so important is because when we're first starting out, we don't necessarily have a lot of what? Capital. Most of us are trying to raise capital, finance something, right? On roofstock.com, they give you your options about financing options, and they also make it more realistic because in other states, look, if you're living in California trying to get into real estate investing, or in New York, you're going to need to have major bank, right? But if you're looking into a different state, maybe like Kentucky, Georgia, Tennessee, South Carolina, Ohio, or someplace like that, real estate could be a lot less expensive, and you could actually start your real estate investment portfolio this way. So check it out and see if it's for you. If it is, great. If it's not, that's okay too. Just tell me what you think about it either way in the comment section below, and share your tips with us and other tips that you have about your selection criteria. So just to go over those selection criteria again real quick, we're looking at town, neighborhood, property size, lot size, property condition, number of units, cap rate, cash flow, and appreciation potential. So no one can really tell you that your investment property should or should not include some of it will actually come down to your preference, such as I only want to buy in Seattle, I only want to buy in New York City, I only want to buy in Houston, Texas, and Fort Lauderdale, Florida, what have you, right? No one can tell you where to purchase. It's, at the end of the day, it's your option. That's why I wanted to mention Roofstock. It gives you that option to specify where you want to invest if it's not in your actual city itself. So by specifying what criteria that you're looking for ahead of time will save you a lot of time when it comes to your search, and your search will be much more manageable in the same way that you'll be able to effectively communicate your desires with any others that want to help you buy property or any type of investment partners, right? So understanding the rules of investment property are pretty interesting. There's essentially like 3 ideal rules, and I'm going to call them ideal rules as a trusted real estate advisor for a reason. Because it's in an ideal world, you'll be able to achieve these numbers, but the closest that you can get to it, the better you're going to be. So if you keep them in mind, keeping in mind that it's not always going to be perfect, but if you get closer to these 3 rules, then you're going to be in a much better position as an investor, okay? The first rule is actually the 2% rule. What the 2% rule states is that your monthly rent should be approximately 2% of the purchase price of the property. So going back to 123 Main Street, if you'd purchased that property at $170,000, what that means is that your monthly rent should be 2% of that, right? So essentially, it would, what that, $3,400, right? So let's put it in an easier analogy for you here. So if you paid $100,000 for a property and you're applying the 2% rule, that means that you would ideally get $2,000 a month in rent for that $100,000 property. Well, this is why, as a trusted real estate advisor, say this is pretty interesting because it's very difficult to achieve and it's not always practical. But if you can get as close to that, maybe 1%, or maybe in your marketplace being at 0.5% or 0.75% is a good option, as long as you got appreciation. Because as homes get more expensive, it's harder to make this rule work at the 2% rule level. So it's an ideal number that many people that teach about real estate investing across YouTube, across the internet, and seminars and stuff would have you try to strive for this 2% golden rule. Something to think about, okay? So rule number 2 is actually the 50% rule. So the 50% rule actually applies into how you manage your money whenever you get that investment income in. And that's a really good thing to start considering. Just because, like, if we go back to our 123 Main Street example in the previous point, and let's say that you were renting it out and you were getting like $2,000 a month and your expenses are $1,100 a month, that leaves you with a gross profit margin of like $900, right? Well, what do you do with that $900? If you take it and you just absorb it into yourself and you're like, oh, I'm going to live off of it and I'm not going to do anything other than just live it and take it, right? that's going to be a little bit of an issue, because here's why. You still got taxes, you still got maintenance on that property, you still have other factors that you need to consider, such as like renovations that might need to be done to it, or maybe some more expensive maintenance that need to be done to it. If you got to replace an HVAC system, you got to replace a roof, you got to do something for the health of the property. You need to be able to allocate 50% of that and put it aside. So some of the expenses that you should be factoring for here would actually include repairs, vacancies on the rental side of it, the utilities, taxes, insurance, management, turnover cost, and the occasional big ticket repairs like I was talking about a moment ago, with maybe having to replace an HVAC unit or an actual roof itself. So those things should be saved up for, and when you save up for those, you're going to be very, very happy that you did, because if you're only taking 50% and putting it into your profit margin that you would take from that property, and then you throw on 50% back towards all the expenses to maintain that property, you're going to be in a comfortable position if and when those situations come up. It's not really so much as a matter of if as it's a matter of when you're going to have to do a big ticket repair, or obviously you know that you're going to always have to pay taxes there. So think about that, okay? The rule number 3 is a 70% rule, and this is my favorite thing as a trusted real estate advisor to hear from investors that maybe aren't doing what you're doing right now with learning all this stuff. They got this thing in their mind about 70% rule that's been hammered into them on different videos and seminars and books that they read and audiobooks and everything. Look, again, this is an ideal rule. It's an ideal thing. It really depends on what kind of market you're in, whether you're a seller's market, a buyer's market, or a flat market. So if you're in like a buyer's market or a flat market, okay, maybe this is going to work. If you're in a seller's market, not so much, because everybody, even the homes that are not in the best of condition, are going to still be getting a premium price. They just may not be getting as much of a premium price. But let's go ahead and explain what the 70% rule is, because the closer you can get to this number, the better off you're going to be as an investor. A real world example of this would be like, okay, let's say that a home should sell for like a couple $100,000, right? And it needs $35,000 worth of work. Well, using the 70% rule, if you were going to be buying this property, you'd want to multiply $200,000 by 70%, and the result would be $140,000. And then when you subtract $35,000 in estimated repairs and renovations to the property, the most that you would be wanting to pay as an investor would actually be like $105,000. Well, obviously, when you're talking about 70% rule, and if the property's out there at $200K and you're talking about $105K, that's a $95,000 price reduction. That's where I, again, stepping in as a trusted real estate advisor, just being honest with you. That is a very, very high hill to climb, even in a buyer's market, to get a seller to drop like that. So then it comes into, where do you find real estate investment opportunities? And there's six starting places to do that, which goes into now the third point of this video, is tying it in to that 70% rule with where to start. Where can you find real estate investments? The first one, obviously, is a multiple listing service, often referred to as simply the MLS. With the MLS, obviously real estate agents are listing property and putting them out there. They could be probate sales, they could be distressed property sales, they could be a lot of different, traditional sale, could be a lot of different kinds of sales out there. And when you're searching sites like Zillow and Realtor.com and Redfin, that's what you're actually seeing, is a feed coming off of the multiple listing service to find these different properties. If you're going to take that route, my suggestion would be is to meet a trusted real estate advisor in your area, sit down with them, design a specific search for the specific type of property, going back to knowing your niche, knowing your strategy, and sharing your criteria, the selection criteria we talked about in the second point of this episode, with that trusted real estate advisor. They can design a search just for what you're looking for, and then you'll get updated in real time all the time whenever properties matching your criteria come on the market, okay? The second one is actually newspaper. Yeah, newspaper's still out there. I mean, believe it or not, it's still out there. They also have online versions of newspapers now too. Check it on the real estate section and see if you can find some for sale by owners, or if you can find some people that are looking for maybe a quick sell. Maybe they know their property is trashed, and maybe they're willing to let go of that property. So now maybe the 70% rule will apply if you take a look at the area and you see all the comparables are selling at 200 and they're willing to let it go at 100 or 110. Okay, that would be a heck of an opportunity. And maybe the reason they didn't want to list with an agent was because they knew it was an awful condition and it was going to take perhaps a cash investor, and they're just trying to approach somebody because they're already taking such a massive hit on the property. Could be an opportunity there. The third way is simple word of mouth. Simple word of mouth by putting it out there. Let people know what you do. I mean, everybody should know. If you're going to be a real estate investor, let everyone know. Your family, your friends, your business colleagues, everywhere you go, everyone should know that you're a real estate investor and that you're looking for certain criteria. That's why having your business plan created up front is so critically important, and having your criteria of what's important to you in your investment property is so critically important. Because then, can you imagine this conversation? You're out somewhere, you're talking to somebody at a restaurant or something, and they're like, oh, what do you do? You're like, oh, I'm a real estate investor. And they're like, oh, how's that going for you? You're like, well, I'm working on getting started. Well, what do you look for? And you're like this, crickets, right? Identify what you're looking for. Know your niche. Know your strategy. Know how you're going to advance your real estate investing career. So when that conversation comes back around, you'll be like, yeah, so I look for single family homes that are at least 3 bedrooms, 2 baths. Ideally, I like them at 1,400 square foot. Who do you know that has a house like that would like to sell it? Because I'm an investor, I'll pay cash, and we can do a quick close. And the worse the condition, the better. In that case, why? Because you can get that price down and get it closer to their 70% rule, right? Something to think about, something to know about. So then the fourth point is, the fourth way actually is Craigslist. Craigslist actually gets a bad rap in different ways, and justifiably so. In other ways, Craigslist gets a good rap, and justifiably so. And in this case, we're talking about real estate investing. So when we're talking about going on the Craigslist looking for real estate investment opportunities, they abound. That's where a lot of for sale by owners will post their stuff or cross-post it. That's where a lot of people that might have properties that are essentially in a destitute condition will go to put it on there. It's the quickest way to do so, and it's the first thing that comes to mind. So check it out and just incorporate it into your business plan to give it a go and see if it's something that's going to work for you. The fifth way is actually your own marketing plan of action. It could be outbound marketing, could be making phone calls, could be making flyers, could be doing online adverts. It could be making your own Craigslist ad that you want to sell to a certain type of person, right? Or a certain type you're looking for a certain type of property. Reiterates once again the importance of having your niche, your strategy, your business plan, and your selection criteria down pat before you do this. The sixth one is actually a website, and I'll make the link available down below. The sixth way is called loopnet.com. And what LoopNet does is it's actually the web's largest place to go for commercial property. If you're looking for smaller multifamily complexes that are in excess of 4 units, which 5 or more generally makes it a commercial property, right? Or you're looking for small apartments, you're looking for middle-sized apartments, big apartments, hotels, or what have you, go to loopnet.com and see if it's going to be right for you. And go ahead and take a look and see what's available. Get your mind wrapped around it and incorporate it into the way that you assess and find property. So then on the fourth point, now going into the fourth major point of this episode, we're going to talk about the home buying process. It's going to be essentially 9 steps. It's going to be very, very quick in this section, so let's go ahead and get to it. Step 1 is decide on your investment strategy and niche. Talked about that a few times in this episode, and if you missed that episode, by the way, it was the 3rd episode in this playlist. So step 2 is to define your selection criteria. That's what we were talking about earlier when we made the comment about Roofstock as well to help you out there. Step 3 is actually getting into how are you going to finance the property. Are you going to pay cash? Or are you going to finance? If you're going to pay cash, great. Have your cash liquidated, have it in an account, and have that bank statement ready to go so that you can provide proof of funds that shows either your LLC or your name on that account with a redacted account number showing the last 4 of that number. Having that ready to go is going to enable you, if you are working with a trusted real estate advisor, to go ahead and make offers. So have that in mind if you're paying cash. Now, if you're going to finance, you want to have your loan pre-approval letter ready to go and be fully prepared with your down payment and buying closing costs of that property, okay? So step 4 is to begin looking on the multiple listing services. Again, if you're going to work with a trusted real estate advisor, why not set a time, meet up at the office, review your selection criteria, what's most important to you, and go ahead and come up with a game plan for looking at the multiple listing service. If you're not going to use an agent, then use the other websites. Just keep in mind their data isn't always updated in real time. So something to think about, but you can find it. loopnet.com, entirely different type of ball game. So if you're looking at commercial property, that is going to be the source that you want to go to find those properties. Okay. Step 5, we're going to be looking into criteria, filters, things that are important to you that should meet the muster in your opinion of what's important to you. So going back to illustrating the perfect deal for you, illustrating the type of property you're looking for, going through your selection criteria, filter it through your lens of what you're looking for by applying your rules that we talked about in section 3 of this episode. Okay, 2% rule, 50% rule, or 70% rule. Apply it and filter it accordingly. So then that takes you into step 6, which is making your offer on your new investment property. Make sure that you're keeping true to yourself whenever you make the offers. Don't get emotional about this. For you as an investor, it's a logical decision. It either fits or it doesn't, okay? So that brings you to step 7. Negotiate the deal with the seller. If you have a trusted real estate advisor, let them help you negotiate that and find the most amicable terms for you. Believe it or not, we trust real estate advisors really just want to help you achieve your goal and make something happen for you. It's just something to think about. So if you're going to be negotiating directly with the first sale by owner, definitely make sure that you can have your home inspections. You always need your home inspections, even if you're just going to flip a property. So at least you know what you get yourself into. You can better factor your cost and also know, again, any kind of headaches or unforeseen issues that might arise from that. Okay, so we'll talk about better negotiation tips in a future episode, just so you know that better help you whenever you negotiate a property. Okay, so the step 8 in this is performing your due diligence. Goes back to those home inspections. Maybe you want a home appraisal. You're going to have a home appraisal if you're getting financed. If you're doing cash, you won't necessarily need one, but you want to have a very good understanding of what that property is currently worth, where it's going, and what you can do to it, and your after renovation value on that. And make sure that it's something that makes sense for you if you're going to flip it or whether you're going to rent it. Apply your selection criteria, apply your real estate rules of thumb to that, and make sure that it fits. That brings you around to step 9, going to the title and escrow office to actually sign documents. Generally the same day, later that day, and depending on where you are in the country, it might be later that week or in a week or two. You will take legal possession of that property once the documents record with the county. That same day, when you're at the closing table and you're signing your documents, if you're paying cash, you need to be prepared to make your final wire, if you haven't already done so, to go ahead and wire the money into the account to pay for that property. If you're financing that property, then your lender is going to be getting prepared to fund that loan. So make sure that you're ready for that with any cash to close that you need to bring to the table between your buyer closing cost and down payment. Okay, that's all I got for you today in this episode. So now it's your turn. Tell me what was the most impactful point of this episode to you. What are you going to take away and use right now in your real estate investment career? Tell us in the comment section below. Was it number 1, knowing how to profit whenever you actually are buying your investment property? Or was it number 2, when we're talking about the importance of having your property shopping selection criteria down pat, or the opportunities that perhaps roofstock.com provides to you? Or was it actually going into the third point of this video, when we're talking about the 6 starting points of how to find your investment property? Tell us about it in the comment section below. Now I'm going to go ahead and pop up my contact information. If you have any questions, or if you simply want to drop me a line and say hello, always love to hear from you. My contact info is below. Thank you so much. So if you've enjoyed this video, you took something new from it, I'm going to ask you to do 3 things. Number 1, please subscribe to this channel. Number 2, please like this video. Number 3, please share it around with someone you know is going to be able to help, because I'm sure that you're thinking of somebody right now, just like you, that could really benefit from this episode. Please go ahead and share it with them. Thank you. So in between now and next time, before we go that far, hold up, sorry, almost made a mistake there. And in the next episode, we're going to actually be talking about how to finance your investment property, so you can go ahead and go forward now if you like, or you can go back to the last episode when we're talking about creating a business plan. It's up to you what you do. And in between now and next time, I'm wishing you and yours a lifetime full of love, wealth, abundance, and happiness. Thank you for watching today, team. Enjoy a great day.